Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Saturday, March 2nd, 2024. Another solid month for the stock market is in the books. In February, the S&P 500 index gained more than 4%, while the NASDAQ Composite Index was up nearly 6%. Even small cap stocks got into the act, rising 5% after lagging the overall stock market in January. So here's a chart of the S&P 500, which we look at pretty much every week. This is a year-to-date chart. If we push it back 6 months, you can see, the bottoming out at the end of October, steady rise, the sharp little dip right at the end of December. Since then, a nice climb, but look right here at the end. So let me zoom in on this. Take a look here, just over the past 3-4 days. And there's a good explanation for that. Wall Street's optimism last month was confirmed by yesterday's personal consumption expenditures price index report, which revealed the index rose 0.3% in January and increased 2.4% over the previous 12 months. Excluding food and energy, core PCE was up 0.4% in December and grew by 2.8% during the past year. So here are the numbers. You look over here in the far right column, that's January. Here's PCE up where I have the cursor, 0.3%. Now if you look over the previous 3 months, December, November, October, PCE hardly increased at all. So that's one reason for concern. However, from a trailing 12-month perspective, which is down here towards the bottom, that 2.4% figure is well below, the 3.0 in October and the 3.4 in September. So what's really happening is some much higher growth months a year ago are being dropped out as these relatively lower numbers are being added back in. So overall, those were the numbers expected, and it validates the decline in bond yields during the past week as well. If you look at, say, 10-year Treasury note, it went from almost 4.3 back down to around 4.1. Not a huge move, but the direction is what's important. Also, and in addition to the bond market, now if the PCE numbers had come in hotter than expected, we might have had a big sell-off in the stock and bond markets over the past 2 days. But instead, all the major stock market indexes were up about 1% or so yesterday, give or take, while bond yields fell. So, nevertheless, I do not believe the Fed is likely to cut interest rates when it meets later this month based on yesterday's PCE report. Although it is encouraging, it is only one data point the Fed must consider when assessing the overall health of the economy. Other data points regarding economic activity and employment suggest a rate reduction is not yet necessary. However, buried in yesterday's report is one fact that indicates a rate cut may be necessary later this year, and that was a decline in consumer spending from 0.7% in December to 0.2% in January. After adjusting for inflation, spending actually declined just barely, 0.1% last month, but in fact it did fall. Much of last month's underspending was largely a reaction to the previous month's overspending during the holiday shopping season. So Wall Street isn't too concerned about the implications of that single data point. 3 days ago, here, let me just open up this next screen for you here. But 3 days ago, the Conference Board reported that its Consumer Confidence Index fell in February to 106.7, down from a revised 110.9 in January. The press release further noted February's decline in the index occurred after 3 consecutive months of gains. Now here's a chart going all the way back till 2007, so you got to go all the way over here to the right to get the numbers for this year. But couple things here, right? You can see the big decline during the Great Recession 15 years ago, then a mostly steady recovery with a few downward movements like this one here, and then of course another big dip in the outbreak of the coronavirus pandemic. Here's what's interesting to me. Consumer confidence spiked 2021, 2022, as stock market was rallying, economy was getting strength, COVID appeared to be under control. But since then it has been lower, and it hasn't got so. Consumer confidence is lower now than it was 2 years ago when COVID was still a problem, supply chain disruptions were still disrupting the global economy. And I'm not sure why that is when everything else seems to be so positive. But nevertheless, that's where it's at. That news didn't get much attention, but if additional data comes in supporting the notion of a slowdown in consumer spending, then the Fed may feel compelled to act sooner rather than later. That may explain the big rise in Bitcoin last month. At the end of January, Bitcoin was trading near 43,000. Yesterday it finished February closer to 62,000. So I'm going to open up a chart here for you, Bitcoin. This is going back a year, and you can see for most of last year it was very steady, around $30,000 or so. But again, once the stock market started rising, so did Bitcoin. But then take a look from really the past month. I've got the cursor right now in the third week of January, where Bitcoin's right around $40,000, and then boom, 50% increase from that point and a 44% gain just over the last 4 weeks. I don't know what, if anything, that signifies about the stock market, but it is another data point worth watching. That's this week's PF Weekly Update, and I look forward to talking to you in another month. Thank you.